Good afternoon, everyone. Thank you for joining us today. I am Zach, the Outreach Coordinator here at the Taxpayers Help Center, and today I'm excited to be here with you to talk about tax filing statuses. The Taxpayers Help Center is a nonprofit 501c3 organization in Northridge, California. We operate two tax clinics, the first of which is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS, and the second of which is our volunteer income tax assistance clinic, in which we help prepare income taxes for free. Additionally, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. So I, Zachary Willan, am the outreach coordinator, and then our clinic director is Masood Chotani. So today during our presentation, we will discuss tax filing statuses. We'll go through each of the five statuses, which are single, married filing jointly, married filing separately, head of household, and surviving qualified widower. And for each, we'll talk about the qualities of each and then what you need to qualify for each of them. And then just a few housekeeping items before we get started. Please make sure your microphone is muted so we can avoid any background noise if you're here during the presentation. And then if you're watching after, please feel free to have or to send an email if you have any questions during any time. Or if you're watching this live, please feel free to leave a question in the chat and then I'll be sure to address that. And then if you experience any technical issues, please let us know through the chat and we'll do our best to assist you. So if you'd like to connect with us, you may do so by email at info@taxpayershelpcenter.com, through our Facebook, which is Taxpayers Help Center Inc., a nonprofit organization. And then we have our location at 9029 Reseda Boulevard, Suite 209, Northridge, California. Our website, taxpayershelpcenter.com, and then our phone number here. And so, yeah, again, if you have any questions during the presentation, we encourage you to connect with us. The Taxpayers Help Center helps taxpayers both locally and beyond, and since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated, and those who can volunteer their time or expertise, or spread awareness are also a great help. So if you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation. Or if you go to taxpayershelpcenter.com and click on the Make a Donations tab, that's a way to get to the donation part of the website as well. And again, anything is greatly appreciated as these donations allow us to do what we do. So today we're going to discuss filing statuses for your tax return. We'll go through each of the five statuses, talk about the requirements to qualify, and then the pros and cons of each status. So first, let's talk about the different filing statuses on a more basic and general level, and then later on we'll go more in depth into each one. So taxpayers are required to choose from one of five filing statuses. Your filing status affects how income tax is calculated, influences the standard deduction amount, and determines eligibility for certain credits and deductions. So here is a list of the current status or of the statuses. And so there are five, as I mentioned, which are single, married filing jointly, married filing separately, qualifying widower, and head of household. And then just a note is non-resident aliens and dual status aliens often have different filing requirements and may need to file Form 1040-NR. So the first status we're going to talk about is the single filing status. So to qualify for this, you must be unmarried. So the taxpayer must be legally single on December 31st of the tax year. This includes those who were never married or those who were legally separated or divorced. Two is legally separated or divorced. So these are individuals who are legally separated from their spouse under a divorce decree or separate maintenance decree, and this qualifies as single for tax purposes. If you're widowed, so if the taxpayer's spouse passed away before the beginning of the tax year and they have not remarried by December 31st, they can also use the single filing status. And regarding the date of status, the key date for determining filing status is December 31st of the tax year, and a change in marital status within the year does not impact the filing status for that year. And then the impact on filing of choosing single is the standard deduction amount and eligibility for certain tax credits. It is often the simplest status, but may result in higher tax rates compared to other filing statuses. And then I'd also like to add that some single taxpayers may be eligible for the head of household or qualifying widower with dependent child statuses, which can result in lower taxes. And we will cover these statuses in more detail later on in this session. So now let's talk about some of the pros and cons. So one of the pros is simplicity. It's the most straightforward and least complex filing status compared to filing jointly or with dependents. It's much easier. And then you have full control over your tax return, including decisions about deductions and credits without needing to coordinate with a spouse as you would with a joint tax return. And then some of the cons are higher tax rates. So the single filers may face higher tax rates compared to married couples filing jointly, particularly in higher income brackets. And then also limited deductions. So you may miss out on certain deductions and credits that are only available to married couples, such as the spousal IRA contribution. So now let's talk about married filing jointly. So you must be married and living together. So both spouses are legally married and living together at any time during the tax year, and they can choose to file jointly regardless of one spouse's income or deductions. So spouses are married but living apart, they can still file jointly as long as they're not legally separated by divorce or separate maintenance decree. And state law determines whether a couple is legally separated. And then couples in a common law marriage recognized by their state can file jointly, provided that the marriage has not been dissolved by death or divorce. And this marriage must be valid under the state laws where it was established or where the couple currently resides. And then a surviving spouse who did not remarry by December 31st of the tax year can file jointly with their deceased spouse. This status is available for up to 2 years following the spouse's death, assuming the surviving spouse meets other requirements for qualifying widower status. So the standard deduction for the tax year 2024 is $29,200. And so one of the pros for this is lower tax rates. So joint filers often benefit from lower tax rates and wider income brackets. And then increased deductions and credits. So eligibility for higher standard deductions and access to credits like the earned income tax credit and child tax credit are more they're more frequent than with single. You have more opportunities to claim credits such as the earned income tax credit and child tax credit. And then some cons are joint liability. So both spouses are jointly responsible for the accuracy of the return and any tax liabilities. And then the complexity of this filing status is more, it's more complex, I would say, than the single one. And that's because you need to manage both incomes and deductions, which could require more detailed record keeping and tax preparation. Okay, now let's go into married filing separately. So, married couples who prefer to file their tax returns individual rather than jointly would file separately. So, this choice allows each spouse to report their own income and deductions separately. If spouses cannot reach an agreement on filing a joint return, they may opt to file separately to avoid conflicts or disagreement. And since the returns are done separately, each spouse completes their own tax return, listing only their income, deductions, and credits. So this means that each spouse is only available for their own tax liability. So the standard deduction for married filing separately for 2024, or excuse me, 2025. Yeah, correct me. I think I may have said 2024 before as well. 2025 is $14,600. In that this is the same standard deduction as filing single and half the deduction of married filing jointly. And this is because you are only filing for yourself and not for two people. And then some pros of this are separate liability. So each spouse is responsible only for their own tax liability and the accuracy of their own return. In certain cases, filing separately can be beneficial for maximizing specific deductions, such as large medical expenses. Some of the cons are higher tax rates, and so this typically results in higher tax rates and a higher overall tax burden compared to married filing jointly. And then many tax credits and benefits, such as the earned income tax credit and child tax credit, are either reduced or just unavailable. And then I would like to correct myself. The standard deduction is actually 15,000 for married filing separately. It is also $15,000 for single and then $30,000 for married filing jointly. And that's because this number is a 2024 number, but of course, it changes from year to year. So, if filing jointly typically leads to the lowest total tax, why might married couples choose to file separately? So, married taxpayers may file separately to avoid being responsible for their spouse's tax obligations. So, by filing separately, each spouse is only accountable for their own tax liabilities, which can be important if one spouse has significant tax issues, such as unpaid taxes or other financial obligations. Another reason for filing separately is the potential for a lower total tax. So, in cases where one spouse has substantial itemized deductions, such as high medical expenses, filing separately may be most beneficial. And this is because a lower adjusted gross income from filing separately can allow for a greater portion of these expenses to be deductible. For instance, if one spouse has medical expenses that exceed 7.5% of their adjusted gross income, filing separately may enable them to deduct more of these costs compared to filing jointly. Who can use head of household status? So, unmarried or considered unmarried on the last day of the tax year. So, to qualify as head of household, you must be unmarried or deemed considered unmarried by the end of the tax year. Being considered unmarried typically means that you are either legally separated from your spouse or living apart from them and have not been living together for the last 6 months of this year. So this status ensures that you are not filing jointly with your spouse and that you meet the criteria for being single or separated. And then you must have paid more than 50% of the expenses required to keep up your home. This includes costs such as rent or mortgage payments, property taxes, utilities, repairs, and food. So essentially, you need to be the primary financial provider for the household to demonstrate that you're responsible for the majority of the household's expenses. And then if you had a qualifying person living in your home for more than half the year. So a qualifying person must reside with you for more than half of the year, with exceptions for temporary absences like attending school. The qualifying person can be a child, stepchild, adopted child, or a relative such as a parent or sibling who meets specific criteria. And so this requirement ensures that the filing status reflects significant household responsibility and care for another person. Who is a qualifying person qualifying you to file as head of household? So, a qualifying person for head of household is defined as a qualifying child who is single, regardless of whether the child is claimed as a dependent, a married child who can be claimed as a dependent person, a qualifying relative who lived with a taxpayer for more than half the year, is listed in the specific chart, or specified chart rather, and can be claimed as dependent by the taxpayer. So let's give a little example and then determine from there whether this is a qualifying person to file as head of household. So Maria is a single mother who supports her 10-year-old son Alex. For the entire tax year, Alex lived with Maria in her home, and Maria paid for more than half the costs associated with maintaining their household, including rent, utilities, and groceries. Alex is a qualifying child because he is under 19, not married, and lived with Maria for more than half the year. So in this case, Alex qualifies as a qualifying person for Maria's head of household filing status. And so this allows Maria to benefit from the lower tax rates and a higher standard deduction associated with this status. And so the standard deduction is for 2025, it is not $21,900. It is, give me 1 second. So it has been increased by $600, so it's now $22,500. And so some of the pros of this are lower tax rates. So head of household status generally offers more favorable tax rates compared to filing as single or married filing jointly. And this can result in lower overall taxes. And then the standard deduction for head of household is higher than for single filers, which can reduce taxable income and lower taxes owed. So there are specific criteria that must be met to qualify, including being unmarried or considered unmarrying and supporting a qualifying person. So failing to meet any of these requirements disqualifies taxpayers from the status. So this is kind of a con because it makes it more complicated and not as accessible for people to use while filing their tax returns. And then it can be determining who qualifies as a qualifying person and calculating the cost of maintaining a home can be complex, and so this can lead to errors and confusion in tax filing. Who can use qualified widower status? So if the taxpayers who do not remarry in the year their spouse passes away can file jointly with deceased spouse for that year. And for the 2 years following the death, the surviving spouse may qualify to use the qualifying widower status. And to be eligible, the taxpayer must have been entitled to file a joint return in the year their spouse died, even if they did not file jointly that year. And so this eligibility establishes the foundation for claiming qualifying widower status in the subsequent years. And then two, spouse's death in either of the 2 prior years and no remarriage. So to qualify for the status, the taxpayer's spouse must have died in either of the 2 years preceding this tax year. And then additionally, the taxpayer, excuse me, must not remarry before the end of the current tax year. Remarriage during this period would disqualify the taxpayer from using the qualifying widower status. And then the taxpayer must have a child, stepchild, or adopted child who qualifies as their dependent for this year. The child must meet all the requirements to be considered a dependent, or they would qualify as a dependent except for reasons like exceeding the gross income limit or being claimed as a dependent by another taxpayer. The child must also be a qualifying child according to IRS standards. The taxpayer must have lived with a qualifying child in their home for the entire year, with exceptions only for temporary absences. So, temporary absences can include situations like attending school or brief vacations, but they must not be long-term separations. And then the cost of maintaining the home. So, the taxpayer must have paid more than half the cost necessary to maintain the household. This includes expenses such as rent or mortgage, utilities, food, and repairs. The taxpayer needs to demonstrate that they are financially responsible for the majority of the household expenses throughout the year. So let's give a little example here. So let's say John's wife Emily passed away in June 2023. John had been eligible to file jointly with Emily for the 2023 tax year. In 2024 and 2025, John qualifies for the qualifying widower status because he has not remarried and he meets the criteria. Let's say John lives with his 8-year-old son Bill, who qualifies as his dependent. He pays more than half the cost of maintaining their home, including rent, utilities, and groceries. And since John meets all the requirements for the qualifying widower status, he benefits from the same tax rates and standard deductions as if he were filing jointly with his late spouse. This helps him reduce the taxable income and pay less in taxes during these 2 years after Emily's death. Also, this is just a note. This status is also called qualifying surviving spouse. So if you've heard that, that is the same thing as qualified widower. So pros and cons. The standard deduction for this is $30,000. $29,200 was for 2024. So the $30,000 is for 2025. And the standard deduction in tax brackets for qualifying widower and married filing jointly are identical and generally more favorable than the head of household standard deduction tax brackets. So one of the pros is favorable tax rates. So the qualifying widower status offers tax rates that are the same as those for married filing jointly, which are generally lower than those for single or head of household. And then the higher standard deduction. This standard deduction is higher than that for single or head of household, and is the same as married filing jointly. And then some of the cons are the limited duration. So this status is only available for 2 years following the year of the spouse's death. After this period, the taxpayer must transition to another filing status, such as head of household or single. And then there's specific eligibility requirements that are pretty strict and include not remarrying or having a qualifying, or you must have a qualifying dependent child. And so this can limit eligibility and require careful adherence to IRS rules. So generally, not always, these are the most favorable filing statuses to use for your tax return. And so number one would be, in most cases, married filing jointly, because this offers the lowest tax rates, the highest standard deduction, and eligibility for various credits and deductions. However, one of the cons of this is that both spouses are responsible for any taxes owed. Second would be qualifying widower. This provides the same favorable tax rates and standard deduction at $30,000 as married filing jointly. And this status is available for up to 2 years following a spouse's death, provided that the taxpayer has a qualifying dependent child. Third is head of household, which has a standard deduction of $22,500. I believe that is, just want to make sure that's correct. Yep, $22,500, and is that is greater than for single and for married filing um, separately. And to qualify, the taxpayer must meet pretty specific criteria, which include having a dependent child and paying for more than half the cost of maintaining the home. And then single is the simplest filing status for those who are not married and do not qualify for other statuses. However, it generally comes with higher tax rates and a lower standard deduction compared to the more favorable statuses. And then lastly is married filing separately. As it results often in higher tax rates and the loss of credits and deductions available to those who file jointly. This status may be chosen to avoid being responsible for the other spouse's tax obligations or to address certain financial situations. But the standard deduction is identical to that of single, and so it's not more advantageous than it. So just to recap, we covered the 5 filing statuses, which include single, married filing jointly, married filing separately, head of household, and qualifying widower. Um, and so with that, that's the presentation. And again, since our services are provided at no cost, donations are vital for supporting and expanding our efforts. We greatly appreciate monetary contributions. Additionally, if you can volunteer your time, expertise, or help spread awareness, your support, excuse me, will be extremely valuable. So thank you all for listening and have a great day. Thank you.